Let me tell you something that most people get completely wrong about money. Not slightly wrong, fundamentally wrong, in a way that costs them every single year for their entire lives. Most people work hard, save carefully, and watch their money sit in a bank account earning almost nothing, and they call that being responsible. But here is what they never stop to consider. While their money sits still, everything around it is moving, prices go up, the cost of living rises, the value of every dollar they saved quietly shrinks. That is not safety, that is a slow leak. And today, we are going to talk about the one system that has helped ordinary people outpace inflation, build real wealth, and change the financial trajectory of their lives. Not theory, the actual mechanics of how it works. This is the bigger picture. I want to start with a story. Not my story. A story that belongs to millions of people, in every country, in every generation, who worked hard and did everything right, and still ended up behind. Think about someone you know, maybe a parent, maybe a grandparent, maybe someone in your own life who worked for decades, saved faithfully, lived modestly, and arrived at the end of that journey with less than they expected. Not because they were careless, not because they made bad decisions, but because nobody ever told them about the invisible force that was working against them the entire time. That force has a name: inflation. And it is the most consequential financial concept that most people never fully understand. Here is how it works. Every year, the purchasing power of money decreases, not dramatically, not in a way that announces itself, but consistently, quietly, relentlessly. Over the last 60 years, and the average rate of inflation has been approximately 3.8% per year. That number sounds small. It is not small. At 3.8% annual inflation, the purchasing power of money cuts in half roughly every 19 years, which means the person who saved $50,000 in their 40s and left it in a savings account earning almost nothing arrived at 60 with money that felt like 50,000, but bought what 25,000 used to buy. They did not lose money in the conventional sense. They lost something quieter and more damaging. They lost time. Years of work, years of sacrifice, years of discipline, slowly eroded by a force they never saw coming because nobody sat them down and explained what was actually happening. And here is the part that makes this story genuinely difficult. The people who suffered this loss were not doing anything wrong. They were following the advice they were given. Save your money, keep it safe, don't take unnecessary risks. That advice came from people who loved them, people who were doing their best with what they knew, but the world that advice was designed for no longer exists. In that world, savings accounts paid meaningful interest, 5%, 6%, sometimes more. Money kept in a bank actually grew fast enough to outpace inflation and build something real. That world is gone. Today, the average savings account pays a fraction of 1%. Which means the advice to save carefully and keep your money safe is no longer safe advice. It is advice that sounds responsible and produces the same outcome as financial neglect. Your money sitting in a savings account today is not being protected. It is being consumed, slowly, quietly, by the same inflation that has been running in the background of every financial life, noticed or not, for decades. So, what is the alternative? Not speculation, not gambling, not the kind of risk that keeps you awake at night wondering if you made a catastrophic mistake. Something more fundamental than any of those. Something that has been available to ordinary people for generations, and that most ordinary people were never taught to use: the stock market. Not the version of the stock market that lives in financial news. The dramatic crashes and the euphoric rallies and the breathless commentary about what the Fed said this morning and what it means for your portfolio by afternoon. The real stock market, the quiet, consistent, mathematically powerful system that has helped ordinary people outpace inflation, build genuine wealth, and change the financial trajectory of their lives for over a century. That is what we are going to understand today. Not which stocks to buy, not which platform to use, not the latest trend or the hottest sector or the investment that everyone is talking about right now. The actual mechanism, how it works, why it works, and why understanding it, that changes everything about how you think about money for the rest of your life. Let's talk about what a stock actually is, because most people have a vague sense of the concept without ever really understanding the mechanics underneath it. And the mechanics are what make everything else make sense. A stock is a piece of a company, not a metaphor, not a financial abstraction, a literal ownership stake in a real business with real employees, real products, real customers, and real earnings. When you buy a share of stock, you become a part owner of that business, small, sometimes very small, but real. And as a part owner, you participate in the fortunes of that business in two specific ways. The first is price appreciation. When a business grows, when its earnings increase, when its products reach more customers and its future looks brighter than its past, the value of owning a piece of that business increases, and the price of the stock reflects that increase, which means if you own shares and the business performs well over time, your ownership stake becomes worth more than what you paid for it. Yet that difference between what you paid and what it is worth today is a return on your investment, not guaranteed, not automatic, not without risk. But historically, over long periods of time, this is exactly what has happened with well-run businesses in growing economies. They became worth more, and the people who owned pieces of them participated in that growth. The second way you participate as an owner then is through dividends. Some companies, when they generate more profit than they need to reinvest in the business, choose to share that profit directly with their shareholders. These payments are called dividends. They arrive regularly, quarterly in most cases, simply because you own shares, not because you did anything, not because you made a decision, not because you predicted anything correctly, because you own a piece of a business that generates more money than it needs, and it is sharing the excess with its owners. That is a genuinely extraordinary concept when you sit with it. Money arriving, not because of your labor, but because of your ownership. That distinction between income from labor and income from ownership is one of the most important financial concepts you will ever encounter. Almost everyone understands income from labor. You work, you get paid, you stop working, the income stops. Income from ownership works differently. You invest, you own something. That something generates returns, and those returns, if you let them, compound. Which brings us to the concept that underlies everything we are going to discuss today: compound interest, or more precisely, compound returns. Here's how it works. You invest $1,000. It grows by 10% in the first year. Now you have $1,100. The following year, that $1,100 grows by 10%, not the original $1,000, the full $1,100. You earn returns on your returns, and the year after that, you earn returns on the returns on your returns. This process, repeated over time, produces something that feels almost impossible when you first encounter the numbers. A monthly investment of $250 at an average annual return of 8% over 40 years produces approximately $1 million. Not because $250 per month is a large amount, because time, combined with consistent returns that compound on themselves, is one of the most powerful forces in finance. And here is the part that most people miss. The returns do not need to be extraordinary for this to work. 8%, 10%. The historical average returns of broad market indices over long periods of time, not spectacular, not the result of brilliant stock picking or perfect timing or access to information that others don't have. Simply, the average return of the market, captured consistently over a long enough period of time. That is the mechanism, not complicated, not requiring genius or perfect information or connections on Wall Street, requiring only two things: consistency and time, both of which are available to almost anyone willing to understand what they are working with. And in the next part of this conversation, We are going to talk about the specific vehicle that makes capturing those average market returns accessible to ordinary people, without requiring them to pick individual stocks or predict the future or trust their financial life to someone else's judgment. Let me introduce you to something. Not a stock, not a bond, not a cryptocurrency or a commodity or any of the instruments that fill financial news with noise and complexity and the constant suggestion that you need to be an expert to participate. Something simpler than all of those, and more powerful than most of them. It is called an index fund, and understanding what it is and why it works might be the single most valuable financial education you ever receive. Here is where it starts. Imagine a league table. If you follow any sport, you understand the concept immediately. Teams compete, the best rise to the top, the worst fall to the bottom, and the table reflects, at any given moment, who is performing and who is not. Now replace the teams with companies. The S&P 500 is essentially a league table of the 500 largest publicly traded companies in the United States. The biggest, the most valuable, the most economically significant businesses in the world's largest economy, companies like Apple, Amazon, Google, Microsoft, but also hundreds of others across 11 different industries, representing the broad sweep of how the American economy actually functions. And like a sports league, the table is not static. Companies that perform well, grow, and rise. Companies that decline, shrink, and eventually fall off the list entirely. The index is always, automatically, a reflection of the current leaders. Now here is where the index fund comes in. An index fund is a financial product that allows you to invest in all of the companies on that list simultaneously with a single investment. Not picking one company, not betting on one sector, not trusting that your judgment about which business will outperform over the next decade is correct. All of them, at once, automatically. And here is why that matters so much. Nobody, not the most sophisticated investor on Wall Street, not the most highly compensated fund manager in the world, consistently predicts which individual companies will outperform over the long term. The research on this is overwhelming. Over a 20-year period, approximately 92% of actively managed funds run by professionals with teams of analysts and decades of experience and proprietary research and every advantage money can buy, underperform a simple S&P 500 index fund. 92%. That is not a small number. That is not a statistical anomaly. That is the consistent, documented, replicated finding of decades of research across markets and time periods and economic conditions. The professionals, on average, lose to the index, and they charge you significant fees for the privilege of losing to it. Index funds, by contrast, are managed passively. They do not require a team of analysts. They do not require anyone to make predictions. They simply track the index, automatically adjusting as companies enter and leave the list, and charge fees as low as 0.03% per year, not 3%, 0.03. The difference between paying 1% per year in fees and 0.03% per year in fees on a portfolio compounding over 30 years is hundreds of thousands of dollars. Not because the investments performed differently, because one arrangement kept more of the returns where they belong, with you. This is why index funds have become the foundation of intelligent long-term investing for ordinary people, not because they are exciting, because they are not exciting, because they require no prediction, no expertise, no ongoing attention, and they have historically delivered the average returns of the market, which, compounded over time, turns out to be extraordinary. The person who invested consistently in a broad market index fund over the last 30 years did not need to pick the right stocks, did not need to time the market, did not need to follow the news or understand macroeconomics or have a relationship with a financial advisor. They needed only to start to stay and to let time do what time does. That simplicity is not a weakness of the strategy, it is the strategy. And in the next part of this conversation, we are going to talk about the practical question that comes after understanding all of this, not which fund to buy, but how to think about starting, when to start, and what gets in the way of most people, even after they understand everything we have just discussed. Let me ask you something directly. If everything we just discussed is true, if index funds consistently outperform the professionals, if compound returns turn modest monthly investments into life-changing sums over time, if the mechanism is simple, accessible, and available to almost anyone, then why are most people not doing it? Not because they lack the information. Most people have heard of the stock market. Most people have a vague sense that investing is something they should probably be doing. Most people understand, at some level, that leaving money in a savings account earning nothing is not a strategy. They know, and yet they have not started, or they started and stopped, or they are waiting for the right moment, the right amount, the right level of confidence. That never quite arrives. I want to talk about that gap honestly, because it is the gap where most financial lives get stuck. Not in ignorance, in hesitation. And hesitation, as we have discussed before, has a very specific and very measurable cost. Let me give you the number that makes this real. A monthly investment of $300 started at age 35, at a historical average return of 8% annually, produces approximately $350,000 by age 65. The same $300 per month started just 5 years later at age 40. Produces approximately $230,000 by the same age. Same amount, same strategy, same market. A difference of $120,000 created entirely by 5 years of waiting for the right moment. That moment, by the way, never feels right from the inside. It always feels like there is something to sort out first. The debt needs to go, the emergency fund needs to be built, the job situation needs to stabilize, the market needs to calm down. There is always something. And while there is always something, the clock is always running. So let me give you the actual sequence that makes starting possible, not a perfect plan, a real one. The first step, before investing a single dollar in the stock market, is to address high-interest debt. This is not optional. It is not a suggestion. If you are carrying credit card debt at 20% interest and you invest in an index fund returning 10%, you are mathematically losing 10% per year on the money you invested instead of paying down that debt. Pay the debt first, always. The second step, before investing, is to build an emergency fund, 3 to 6 months of essential expenses, kept in a liquid account, available without selling investments. This is not caution for its own sake. This is the structural protection that allows you to stay invested when life goes wrong. Because life goes wrong. Medical bills arrive, jobs end unexpectedly, cars break down, roofs fail. The investor without an emergency fund faces these moments with a terrible choice. Sell investments at whatever price the market offers today, which is often not a good price, or go into high-interest debt to cover the gap. Both outcomes are expensive. The emergency fund eliminates the choice entirely. These things are handled, the investments stay invested, and the compound returns continue uninterrupted. Once the debt is managed and the emergency fund exists, you are ready, not perfectly ready, not with complete certainty about the future, ready enough, and ready enough, acted upon consistently, is the only readiness that has ever built anything real. The question after that is not which stock to buy, the question is how much to invest, and the honest answer is whatever amount you can sustain consistently, not the maximum possible, not the amount that requires sacrifice so significant it becomes unsustainable. The amount that fits your actual life, that you can commit to automatically, that you will not miss, and that will compound quietly in the background of your financial life. For as long as you let it. A simple rule that many investors find useful is the 70-20-10 framework. 70% of income toward living expenses, 20% toward investments and savings, 10% toward whatever brings genuine enjoyment to your life. Not because those numbers are magic, because they represent a structure that keeps investing happening consistently. without making financial life feel like deprivation. And consistency, as we have established, is the whole game. In the next part of this conversation, we are going to talk about what happens after you start, the forces that pull people away from a sound strategy, even after they have done everything right, and how to build a structure that protects your investments from the one variable that derails most investors, themselves. Let me tell you about the biggest risk in stock market investing. Not market crashes, not inflation, not geopolitical instability or rising interest rates or the kind of economic uncertainty that fills financial news with alarm and urgency and the constant suggestion that something terrible is about to happen. The biggest risk is you. More specifically, it is the gap between what your investment strategy requires of you and what you are actually capable of doing in the moments when it is hardest to do it. Let me explain what I mean. An index fund strategy is simple. Invest consistently, stay invested, let time work. 3 steps. No complexity, no expertise required. And yet, the average investor dramatically underperforms the index funds they invest in. Not because the funds failed, because the investors did not stay. They bought when markets were rising, because rising markets feel safe and exciting. They sold when markets were falling, because falling markets feel dangerous and urgent. And in doing so, they bought high and sold low, which is the precise opposite of what building wealth requires. This pattern is so consistent, so well documented, so reliably repeated across generations of investors, that researchers have given it a name: the behavior gap, the difference between what the market returns and what the average investor actually captures. Because of the decisions they make in the moments when staying the course feels impossible, and those moments arrive for every investor, without exception, the market drops 20% in a month. Your portfolio, which represented years of consistent investing, loses a significant fraction of its value in weeks. The financial news is catastrophic. Every commentator has a theory about why this time is different, why the recovery that always came before might not come this time. And somewhere in that noise, a voice arrives. Get out, stop the bleeding, do something. That voice is not irrational, it is biology. The same instinct that kept your ancestors alive in genuinely dangerous situations is responding to the perceived danger of watching numbers go down. But here is what that voice does not know. Every single market decline of 20% or more in the last 100 years has been followed by a recovery. Not quickly, not comfortably, not without further pain along the way, but always. The market has always recovered, and the investors who stayed captured that recovery. The investors who sold at the bottom locked in the loss and then faced the second hardest decision in investing: when to get back in. A decision that is almost always made too late, after the recovery has already happened, after the best days, which almost always follow the worst days, have already passed. A study found that if you miss just the 10 best trading days in the market over a 20-year period, your returns were cut in half, 10 days out of more than 5,000. The best days arrive when everything feels worst, and the investor sitting on cash, waiting for certainty, misses them entirely. So how do you protect yourself from yourself? Not through willpower. Willpower depletes. It weakens under stress. It fails in the exact moments it is needed most. Through structure, automation that makes investing happen regardless of how you feel on any given day. A written investment policy that you create when you are calm, that tells you what to do when you are not. A clear understanding of your time horizon, so that a drop in the market today is understood as irrelevant to money you will not need for 20 years, and perhaps most importantly, a deliberate reduction in how often you check your portfolio. The investor who checks monthly makes different decisions than the investor who checks daily, not because they are smarter, because they encounter fewer opportunities to make decisions driven by fear rather than strategy. The market will crash again. It always does. And when it does, the question that determines your financial outcome is not what the market does next, it is what you do next. Stay. And the recovery works for you. Leave, and the recovery happens without you. That choice is the whole game. And building the structure that makes staying the default behavior, rather than the heroic act of discipline it feels like in the moment, is the most important investment work you will ever do. If you are still here, I want to stop for just a moment. Because what we have been building together in this conversation is something most people never receive. Not a tip, not a recommendation, not the kind of financial content that tells you what to buy this week and why this moment is different from all the others. A framework, a genuine understanding of how the stock market actually works, why it has historically rewarded patient investors, what gets in the way of most people capturing those rewards, and how to build a structure that protects you from the forces, both external and internal, that derail most financial lives. That framework is yours now, and it does not expire. It does not require a subscription or a brokerage account or a minimum balance or a meeting with someone in a glass office who has products to sell you. It requires only the decision to use it, which is always and only yours to make. So if this conversation has shifted something, if something here has landed differently than the financial content you usually encounter, I want to invite you to stay close to this channel, subscribe, so the next conversation reaches you when it is ready, and share this with one person in your life who needs to hear it. Someone who has been meaning to start investing for years and keeps finding reasons to wait. Someone who has money sitting in a savings account earning nothing, while inflation quietly does its work. Someone who deserves to understand the mechanism. Before more time passes, this conversation might be exactly what changes that. And now, let's finish what we started, because we have covered the ground that most financial education never reaches. We talked about inflation and why saving carefully is no longer the safe strategy it once was. We talked about what a stock actually is, ownership in a real business, and the two ways that ownership generates returns. We talked about compound returns and how modest, consistent investments become extraordinary sums when given enough time. We talked about index funds and why they have consistently outperformed the professionals who spend their careers trying to beat them. We talked about the sequence that makes starting possible: debt first, emergency fund second, then invest what you can sustain consistently. And we talked about the behavior gap, the most expensive phenomenon in personal investing, and how to build a structure that protects your strategy from the moments when everything in you wants to abandon it. But there is one more thing, the thing that ties all of it together. Not a strategy, not a framework, not a concept, a question. The question that every investor who has ever built something real has answered honestly before they started. Not what should I invest in, not when is the right time to start, not how much do I need before this makes sense. The question underneath all of those, what am I actually building toward? Not in abstract, not in the language of financial planning, in the specific, honest, deeply personal terms of the life you are actually trying to create. What does financial freedom look like for you? Specifically, not the billboard version, not the social media version, yours. Because the answer to that question changes everything about how you invest. It changes your time horizon. It changes your risk tolerance. It changes how you respond when the market drops and the voice arrives, and everything in you wants to make it stop. Because instead of asking, "Am I losing?" you ask a different question, "Am I still on track?" And those two questions produce completely different investors. That question is exactly where we are going next. I want to end with something true, not a summary, not a checklist, not the kind of conclusion that feels complete in the moment and forgotten by morning. Something true. The stock market, for most of its history, has been presented to ordinary people as something that belongs to someone else. To the professionals, to the wealthy, to the people with access and connections and information that ordinary people simply do not have. And that presentation, deliberate or not, has kept generations of ordinary people on the sidelines, watching from a distance as a system that could have worked for them worked for someone else instead. Here is what I want you to take from this conversation. The stock market is not a casino. It is not a place where the house always wins and the ordinary investor always loses. It is not a system designed exclusively for the wealthy. It is, at its most fundamental level, a mechanism for ordinary people to own pieces of extraordinary businesses, to participate in the growth of companies that employ millions of people, create products used by billions, and generate profits that compound over decades. Not by predicting the future, not by picking the right stocks at the right time, simply by owning consistently, patiently, for long enough that time does what time does. The evidence for this is not theoretical, it is historical. Over every 20-year period in the last century, a diversified portfolio of broad market index funds has delivered positive returns, not in some years, not in good economic conditions, in every 20-year period, including periods that contain the Great Depression, 2 world wars, multiple recessions, oil crises, financial crashes, a global pandemic. The market absorbed all of it and came out higher on the other side. Every time, that is not a guarantee of future performance. Nothing in investing is guaranteed, but it is the most consistent pattern in the history of financial markets. And ignoring it, because the short term is uncertain and the news is alarming and the voice says this time might be different, is one of the most expensive decisions a person can make. Here is what I want you to do after this conversation. Not open a brokerage account today, not make a major financial decision based on a single video. One thing, calculate the real return on wherever your money is sitting right now. Not the number in the account, the real return. Subtract inflation. If your savings account is earning 1% and inflation is running at 3%, your real return is negative 2%. Your money is shrinking, not because you made a bad decision, because you have not yet made the decision that changes it. That decision is not complicated. It does not require expertise or perfect timing or access to special products. It requires understanding what you now understand and taking one small deliberate step toward putting it to work. The best time to start was 20 years ago. The second best time is now. Not because the market is at the right level, not because the economic conditions are favorable, not because you have figured out every detail and eliminated every uncertainty, because every day that passes without your money working is a day of compound returns that cannot be recovered, and you have already lost enough of those days. Start, not perfectly, not with complete certainty, but deliberately, with the understanding that time is the one resource in this equation that no amount of money can replace once it is gone. If this conversation has been worth your time, share it with 5 people who have money sitting still right now. While inflation quietly does its work, they deserve to understand the mechanism. Leave a comment below. Tell me what you want to understand next. What part of the stock market still feels confusing or intimidating or somehow designed for someone else? Ask it here, because the next conversation starts with what you need most. This is the bigger picture: money, wealth, and the life you're building. We'll see you in the next one.